Good evening, viewers. This is Sharmila from the products team of HDFC Securities Limited. Welcome to this webinar on how to invest your bonus money and get your investment pyramid right. To help us achieve this, we have Mr. Deepak Chisani, who is a head retail research. So thank you, Mr. Deepak, for joining this discussion. At the end of the discussion, we will take a Q&A session. Now, please note that the Q&A session will only pertain, question and answers would only pertain to today's topic. So now over to Mr. Deepak Chisani.
Thank you, Sharmila. Most people working in India typically receive their yearly or annual bonuses either in Jan, Feb or in April, May. So we at HDFC Securities thought that this was a good time to talk about how to invest the bonus money so that the annual inflow is put to good use, and hence this webinar. While some of what we will discuss may be known to a lot of you, what we have tried is to make a structured talk covering most of the aspects of the matter. Now it's bonus season and the usual dilemma is about how to use the lump sum amount. It is natural to think short term in such a case and assume that the present abundance will last forever. But short term plans and long term wealth creation do not go together. Being rewarded a bonus is surely an achievement, but utilizing your bonus wisely will be even better achievement. Bonus component is over and above your monthly regular paychecks, which means that the employees hardly treat this amount like their monthly salaries. There are no fixed monthly outgoes like out of your monthly salaries. Windfall gains and bonuses should be channelized and invested in suitable avenues in order to meet one's medium-term and long-term financial goals. Money has the power to compound, multiply and earn returns over a period of time if invested properly.
So Deepak, how should one start allocating money that has been received?
Yeah. So now, first of all, you should first decide as to how much money you want to invest out of the monies received. So that is the first step. Most people do it the other way, in the sense that they first list out what is to be spent out of the bonus, and then whatever is the balance they plan to invest. Now, in some cases, typically you are not left with any surplus monies to invest. So it is better that you first have a target of amount you want to invest, and then the balance you can allocate or spend on different objects. Now, once you have decided as to what is the amount you want to invest, first thing that you need to do is that you should pay off your high cost existing debts. Now typically the personal loans or credit card debts carry a very high interest rate. So the first use of your lump sum bonuses should be to clear a lot of such debts. Now, if as you may be aware, high interest rates eat away a lot out of your income and affects your wealth building capacity over the medium term. So you should try and bring it down as much as possible out of your bonus receipts. Then after that, you can look at spending money on consumer durables like refrigerators, TVs, ACs, etc., which will make the life of your family more comfortable. And then if you want, you can also look for short trips that you have been postponing all this while. After that, you also can look at creating a contingency fund. Now, in case you have not already created a contingency fund, because we can never predict what lies ahead of us. So for emergencies and contingencies, we should ideally set apart some fixed amount which will take care of a few months' expenses. So that should ideally be invested in liquid funds or short-term income plans where the volatility in interest rates are low. This will also give you a comfort of dealing with emergency situations. You can also afterwards look at spending some amount out of your lump sum on enhancing your skills, which in turn will increase your income generating capacity in the future.
Mr. Jasani, do you think there is a prescribed form of investment for all?
Basically, they first we will have to look as to how do we go about investing after we have done all this, after we have allocated monies towards contingency, towards repaying debt, towards trips, and towards your skill enhancement. Then the balance needs to be gainfully invested. Now, one can also look at tax planning as an essential part to build your wealth over time. Insurance, mutual fund, NPS are some categories where you can invest some part of your money, initially at least. Insurance is a necessity, especially the term insurance. In case you are the sole breadwinner, then you should have enough term insurance on your life so that your dependents are not left uncovered in case of any eventuality. So your insurance cover, whether it is sufficient or not, please check that. In case it is not sufficient, maybe you need to top up your insurance. Then we all of us have some sort of goals in our mind. The goal could be buying a car, buying a home, education, wedding, vacations, etc. So now thoughtful and planned investment can help us achieve those goals in time. Now you need first to estimate as to what are your goals, when do you want to achieve them, and what is the amount that you will need to spend on those on achieving those goals. So once you are having that rough figure with you, then we need to expect a percentage return on whatever you are going to invest. Now typically that percentage return keeps changing from time to time. When the interest rates are on the way down, then you will have to bring down your expectations and sort of allocate a little more towards equity where the chances of appreciation are a little higher. Then you have to reverse calculate as to how much money you will have to invest every month or on lump sum basis to achieve those goals over that time period. So this can be done out of your monthly savings also, but lump sum investments out of receipts like bonus will help you to accelerate your goals or achieve them faster, or have a larger end of the period corpus to spend on your goals. Now, as far as your question is that whether we can have a standard prescription of investments for all, this is not true. We cannot have a standard prescription because investments typically is a combination of risk and return. Everybody typically would want to have the highest return, but at the same time, what kind of risk you are willing to take or able to take is more important. Everybody's risk profile is different, so you need to sort of look at yourself as to how much risk you can take, what is your risk taking ability, and what is your risk taking emotional capacity. These two things combination you will have to yourself do. You can take help of your relatives or friends also to arrive at this, because evaluating self is a little tricky. Now, the allocation of your funds between lesser risk assets and higher risk assets will typically depend on your risk aversion. Now, there is a difference between risk aversion and risk capacity. Now, risk capacity typically is the objective ability of an investor in terms of financial capacity. Mainly it is in terms of financial capacity. How much wealth you have, how much income you have, what is your liquidity needs, what are your tax rates, what is your investment horizon, etc., etc. So, there could be a case of a wealthy investor who has a high risk taking capacity. So, on the one hand, we should look at what is your risk taking capacity. On the other hand, there is risk aversion. Now, risk aversion is the combination of psychological traits and emotional responses to that determine the investor's willingness to take financial risk. Now, this means that emotionally how the investor is mature enough to react to situations of loss or MTM loss or actual loss. MTM is mark to market loss. So basically, you need not sell all your assets which have fallen in value. But whether at the end of the day, while going to sleep, does the fact that your investment has fallen 10%, 20% from your entry level bother you so that you are not able to sleep properly at night? So that is what is the emotional response of the investor towards the situations or loss making investments. So these emotional factors are even more difficult to interpret, and but at the same time you will have to do this exercise so that you come to know as to what is your overall risk profile in terms of your capacity and your aversion. So once you decide about your risk taking capacity and risk aversion, then you will go to the next step, in the sense that the what should be the split of your investments into various risk bearing instruments. Now coming back to the risk aversion, experiences of individuals between the age of 16 to 25 influence their investment beliefs and their risk profiles for a long time. Typically whatever we have undergone in that period will stay in our mind forever, for a quite a long time, till there are some other circumstances which make us change our belief process. Your risk profile will also depend on to a large extent on the genetic prescription predisposition. Basically, how does your family, your parents, your uncle, the people you stay with, how do they react to risky situations? Whether they are okay with temporary falls in the stock prices, etc., etc., or they are not okay. How do they react to such situations? So basically, that is imbibed over time in your mind. The influences of your environment and the people you interact with. Now, in your office or in your college, the people you deal with day in and day out, how do they react to risky situations, or how do they react to temporary fall in the values of whatever they are holding? So this also etches on your mind. Apart from these, the stage of your career, your the health conditions of your family are some other important considerations which will impact, or which will sort of decide what is your risk profile.
Mr. Chasani, now that you have identified what is your risk profile, what do you think is important? I mean, investing into equities, mutual funds, into SIPs or direct, or what is it like? I mean, if you can give us a brief.
Yeah, now most of you would be aware of equities as an instrument of creating wealth, but at the cost of small repetition. Equity investments have beaten all other asset class over the medium and long term. Equity markets more or less mirror the economic growth of a country, and currently India is one of the fastest growing economies in the world. So in that sense, it is normal to expect that the equity markets in India will do well over the next 3, 4, 5 years. So in that sense, for people who are willing to take some risk, equity investments is a necessary portion of your investments. Only then you will be able to beat the fixed income returns, beat the inflation, and reach your financial goals faster. Equity investments over time have beaten all other alternative asset classes like gold, fixed income, inflation, etc., by a comfortable margin. So, in that sense, equity as an investment avenue is quite clear in terms of its attractiveness. Now, whether one should go for a direct equity or go through a mutual fund, that is your next question. Now, when you cannot devote sufficient time or you don't have sufficient expertise in direct equities, then probably investment through equity mutual funds is always preferable. Now, mutual funds are typically managed by expert fund managers with rich experience and background, and they continuously sort of review their processes and their investments on a day-to-day basis with a view to beat their benchmarks and their category peers. So this would mean that the returns that they generate are typically higher than the Nifty returns. In India, most of the equity mutual funds have beaten Nifty over medium term, long term. There have been a few laggards, but that is where the advice of an advisor will come in place. Now, if you go through mutual funds, then the probability of beating the fixed income returns and Nifty returns will increase. And this will also help you build wealth in a systematic manner and requiring very little time devotion from you. just a periodical review once in 6 or 9 months of the various schemes that you have invested should be good enough, rather than doing it on a daily basis or on a weekly basis. So basically, mutual funds should be used by people who don't have enough time or enough expertise. And we at HDFC Securities continuously do research in various fixed income instruments, debt instruments, and mutual fund schemes, and come out with various research products, including ready reckoners on debentures and ready reckoners on mutual fund schemes. And these are very well read and appreciated by most of our customers. Now, let us look at how to invest the balance amount or bonus inflows into the investment, as it were. So let us start initially with conservative investors. Now, conservative investors typically are very afraid of volatility in the market values of their investments. Interest risk and credit risk is something which they don't want to take. They want fixed income and fixed guarantee of return of principal. So typically these investors will tilt towards debt investments more, where the volatility in the interest and some risk of principal does not exist in most cases. They are okay with lower returns. If you are having recurring liabilities to pay off and have uncertain productive earning life ahead of you, then it is better that you avoid taking too many risks. Protecting capital is of utmost importance for you while earning some return on your investments. For such conservative investors, we think a monthly income plan long term and RBI 8% taxable bonds are two avenues where they can put their money into, because the proportion of equity investment in this is either nil or minimum. So there is very little downside risk in them. Now, among the monthly income long-term plans, we felt HDFC monthly income plan long-term plan is worth looking at. In RBI taxable bonds, basically these are 6 years 8% taxable bonds issued by the RBI. Minimum investment is 1,000 rupees and there is no maximum limit. There is an option of cumulative of half yearly interest. Interest is taxable completely, so your post-tax return would be about 5.5%. Premature withdrawal is permitted only for senior citizens after 3 years of lock-in, subject to some penalty. There are other options also for very conservative investors. Basically, if you have a daughter who is less than 10 years, then you can put some money into Sukanya Samruddhi Yojana. Basically, here you get 8.6% yearly compounded rate of interest. And however, this scheme lacks liquidity. Premature withdrawals are not permitted or permitted only under certain conditions. So this is as far as the conservative investors are concerned. Now going to the medium risk investors. Now if you are more than 50 years of age and have limited productive working life ahead of you, you can take some risks. You can afford to take some risk, but you have to be watchful of capital erosion, even if it is a temporary. Now here you can look at investing in balanced funds that have some exposure to debt in addition to equity. This helps the schemes to withstand the downturn in the equity markets better than pure equity funds. A small portion of your monies can also be put in multi-cap equity funds, which carry a slightly higher risk than the balanced funds because of the entire exposure to equity funds. But because they have investment across the market cap, they will try to balance their proportion in the various buckets based on the market conditions. So when they think, when these fund managers think that the markets are about to turn downwards, they will reduce the exposure to the small and mid cap and shift it to the large cap. So by doing that, they will sort of withstand or lower the downward fall in their NAVs. So among the balanced funds, we thought HDFC Prudence Fund is an attractive option. This fund has been giving regular 1% dividend offering since January 2016, and their NAVs have also not fallen since that day. So in that sense, they are not paying dividends so far out of capital. These dividends are tax-free in the hands of the receiver. So you are getting so far 12% tax-free yield on your investment in this day and age. Of course, when the equity markets go down or interest rates head up because of their small exposure to debt, their NAVs will face some turbulence. But if you are a slightly medium-term investors, then probably they will make good that depletion in their NAVs, and by the time you exit, probably the loss of principal will also be avoided. The among multi-cap funds, one can look at ICICI Pru Value Discovery Fund. Now, this is also a very happening fund, has given very attractive returns over time. The 1 year and 2 year returns have been 23 to 25% on a rolling basis, and trailing basis the returns have been about 17.5 and 23%. So we look at rolling return also in addition to trailing returns, so that it gives a fair picture of entry at different point of time and exit at different point of time. Now, if coming to the high risk takers, now if you are say 35 to 50 years of age and have a long productive working life ahead of you, you can afford to take high risks, because even if you lose some money, you have a long working life ahead of you to recoup those losses. Here, direct equity exposure based on your broker's advice or on your own research, if you have enough time and inclination, is recommended. Now, at HDFC Securities, we have a decent track record of our pick of the weeks. Now, this reports we have been generating over the last more than a year. Every Monday, there are 2 picks of the weeks coming out of our stable. Going by the track record of the last 1 year, we have issued 122 reports, out of which about 92 have reached their target, generating an average return of about 22%, and the average holding period is about 84 days. So this kind of returns are possible in direct equity exposure, but you will have to be very disciplined in this. At times, the recommended stocks can go beyond the target also, but you will have to take a call whether you want to keep churning based on the recommendation, or you want to take your own decision as to which ones you want to keep holding or which ones you want to sell as per the targets. So if you keep compounding this, if you keep reinvesting these monies, then probably you can do it say 4 times in a year. So your return theoretically can go up to more than 80%, but let us not have such high expectations. Markets have also been kind so far. So having an expectation of say 25-30% per year is possible, even in a regular condition, not a bull market kind of a scenario. So that is what one can look at in terms of direct equity exposure. This apart, you can take small exposures to equity mutual funds having exposure to small and mid caps, because they are slightly high risk. Small and mid caps typically rise very fast and they fall also more than the large caps. Here one can look at Reliance small cap fund. Now, Reliance small cap fund on a rolling return basis has generated return of 27% and 32% for 1 and 3 years, and on a trailing year basis it has generated returns of 44% and 39% over 1 and 3 years. Of course, the standard deviation or variation in returns is also higher than the other scheme which we mentioned some time back. Right.
Thank you, Mr. Chisani. That was, very detailed information. Do you have any closing remarks, probably which can help?
Yeah. So now here there are some things I would like to mention. One is that please make this an annual exercise. Discipline yourself to follow these steps year after year. Whenever you receive large one-time payouts, regularly paying off debts, and with the power of compounding, helping you grow your wealth, you will soon find yourself in a situation where you are left with more and more disposable income in your hands, which you can now spend on living your life in a far better way. Secondly, start investing at an early age. So what if you have got a not a very large sum as bonus because you are so young? Any sum which you start investing, looking at the compounding effect, has the potential to grow big over time. Compound interest is a magic which works diligently in the financial markets over time. Now, the longer you stay invested, the early you start investing, the bigger your end of the period corpus will be. For example, if you had invested say 10,000 rupees in the stocks listed on the Sensex in April 2002 and stayed invested till March 2017, your wealth would have grown by 15.3% per annum compounded. And if you are invested in some mutual funds, of course, they would have beaten the Sensex by a wide margin, maybe by 22, 25, 30% also. So please start investing at an early age. Just because you are 24 or 28, it doesn't mean that you don't have to save or invest productively. Now, and the last issue is whether there is always a dilemma as to whether you should be investing regularly or whether you should invest lump sum. Now, the answer to this is whether can you time the markets at all? If the answer is yes, then probably lump sum investment is preferable. But most of the time, timing the market is difficult. Movement in the markets are dependent on various factors which are impossible for anyone to track. If you invest regularly in the markets, timing the market does not matter over the medium term. People also at times compare the SIP returns with lump sum returns. Now SIP investments will work well if you start investing in a falling market, because you will get the benefit of lower entry prices. And lump sum investment works well when you are investing in a rising market. However, over time, both the lump sum and SIP have generated similar returns if over a medium term period of 7 to 10 years. Now, so net from your monthly income, please keep investing in SIPs regularly, and from the lump sum amounts that you receive periodically like bonuses, you should invest lump sum amounts also, and both this will result in your wealth growing in a systematic and disciplined manner over time. Yeah.
Okay. Thank you, viewers. Now, what we'll do is we'll take some question and answers. Okay. We have a lot of questions here. Probably we'll take some few which are quite commonly being put up here. Now, we have one viewer from Pune, Dr. Ramchandran, who says he's 62 years and he has already a regular SIP in equity and mutual funds. So he wants to know now, apart from this, is there anything that he would want to invest his money in?
Yeah, as we discussed, you can do both SIPs as well as lump sum. Now, for SIP, any time is good time. For lump sum, maybe the markets, equity markets are a bit frothy. It doesn't mean they will fall from tomorrow or the next week or the next month. But lump sum investments, you can have a modified kind of a SIP. Basically, you can spread over your lump sum investments into 3 parts or 4 parts over the next 3 or 4 months. So that you will have the benefit in case the markets fall also, then probably you will have a good entry level, averaged out entry level. So that is how you should be doing.
Okay. Thank you, Mr. Chisani. We have another viewer who would want to know whether investing into gold, okay, he is basically from Delhi. He wants to know whether investing into gold is a good option, especially these sovereign gold bonds.
Yeah, gold basically is an asset class. So one should not be looking at gold as a regular income generating asset. So let us be very clear about that. In the past, of course, gold has risen in specific periods very sharply. So most people are attracted to that kind of return expectations going forward. But now probably the situation has changed a little. So gold should be a portion of your portfolio, up to 5 to 10% of your portfolio, mainly as an inflation or a currency hedge. All said and done, we are a developing country. We are prone to shocks. Of course, the last few years have been good enough for us, but we cannot rule that out for maybe for another till we have a good experience over the next 3 to 7 years. So, inflation and currency hedge is what you should be looking to invest gold in. Whatever returns you get is an additional bonus. So whether 2.75 or 2.5% yield that the SGBs give, plus the appreciation or the depreciation, either way, is the return that you will get. But the main motive of investing in gold should be hedge against currency or against inflation.
We have one viewer from Thana who wants to know, is getting your bonus and investing into IPOs, is it a good decision to do? And how does research retail help in investing into IPOs?
Yeah, basically, bonus can be used for applying in IPO. There is no doubt about that. Good IPOs coming out. So for any beginner in the equity markets, IPO is the first step. IPO in well-established companies, even though they are coming with at high premium, most of the times if you enter at the IPO stage and you are lucky to get an allotment, either you can sort of sell it on listing or you can keep holding on. So depending on how much study you make post your allotment, whether you want to sell it, even if you want to sell it and at a good profit, it is you can reinvest that money into another IPO. Or if you think that this company is going to give you returns over the medium term, like a lot of IPOs in the past, you can keep holding on to it because your entry price is a reasonable amount, and if the market price is already ahead or above the entry price, then there is no hurry for you to get out or book profits, and you have enough margin of safety to withstand downturns in the market. And we come out with IPO notes, HDFC Securities, and so those you can go through and then take your own decision. Be in touch with your RMs. They will also be able to guide you in that.
Okay. We have one viewer from Durgapur who wants to understand. He wants to invest into mutual funds. Okay, so he says, is it the right thing to invest a total amount into a mutual fund at one shot, or over a period of 6 to 10 months, and do a staggered investment into mutual fund?
Correct. Now this again depends on how much money you have already invested in the similar mutual funds. So now if you have say already invested 100 rupees in the equity mutual funds and you have another 20 rupees to invest, so any time is good enough for even that lump sum investment. But if you have not invested, or if you have invested only 20 rupees so far and you have another 20 rupees to invest, so then you may look at staggering your lump sum investment. As I discussed some time back, you can stagger it over next 3 or 4 months in equal parts. So by that way you can probably hedge your bets and hope for a better entry level.
Okay. We have one. We'll take the last question probably for today. We have a viewer from Bangalore who wants to understand that, is this the right time to invest into the equity market?
Yeah. So now
entry into the equity market.
Correct. So again, we'll have to look at what is your existing portfolio size. Are you a first-time investor, or what kind of money you want to invest vis-a-vis the money already invested? Now, for equity investment, direct equity investment, any time is good time, in a sense that we keep coming out with fundamental reports and technical reports once, twice, thrice a week, and most of those reports achieve their target soon enough. So although the overall index may look high, at a high level or ripe for a correction, but there will be various sectors and stocks which will keep doing well even in these markets. There will be sector rotation, there will be stock rotation. So in case you are able to pick the right sectors or right stocks, then you will make money even in these markets. So it all depends on who do you rely on, whether you do enough study yourself or you rely on your broker, to what extent. And so then I think any time is good time to invest. For mutual funds, of course, you can look at staggering your investment a little bit, because there the flexibility, your flexibility is limited in terms of stock selection.
Okay. That was the last question that we took, though we have a lot of questions here. However, we'll try and answer them individually if possible through your emails, if that is possible. I would really like to thank all viewers today who joined in on this discussion. I believe that this has made you a little more wiser, and that will help you into investments going forth into both equity and the mutual funds. In case if you do have any questions, you're most welcome to call up our customer care, and they'll be there to help you. Thank you, viewers. We end this session.
Thank you.
Thank you, Mr. Jasani, for that wonderful discussion that we had.